Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Juan Artigas, Global Head of Research at the World Gold Council, with his 2022 outlook in the gold space and beyond. Juan, it's great to see you as always. Welcome back to Trade Talks.
Thank you so much for having me today, Jill.
All right, and let's kick it off right at the top. What's your outlook for the end of the year and as we head into 2022 for gold?
At present, there are two competing forces for the gold market and gold price performance. On the one hand, we have risk, whether it is in the form of high inflation or, for example, new variants on COVID and additional concerns on the stability of the economic recovery that are keeping gold very well bid and looked after from investors as a means of hedging their portfolio. However, there's another competing force, which is the higher opportunity cost, namely the speed and the strength of increases in interest rates that can tend to provide or create headwinds for gold. At present, our view is that the risks are likely to outpace this increase in opportunity costs, so that because of, again, inflation likely becoming more persistent, as well as unforeseen risks in portfolio, investors will continue to look for gold as a hedge against overall risk in their portfolio. And therefore, the impact of higher interest rates is either likely already priced in to a good degree, or that it may not necessarily affect as much. But that's something that we are looking into very much, as it will determine the performance on the year.
According to a survey conducted by the World Gold Council and Coalition Greenwich, 40% of current institutional gold investors plan to increase their gold allocations in the next 3 years, and 4 in 10 non-gold investors plan to do so in the coming years. So tell us more about that survey and its results.
That's a very interesting trend we've seen, not only through the survey, but even before, perhaps a little bit more anecdotally. But the survey was able to confirm some of these anecdotal evidence. More and more institutional investors, long and hold long-term investors, are adding gold to their portfolios. And that is in part a byproduct of the ultra-low interest rate environment that investors have experienced for a really long time, that is changing structurally the way that they allocate into different asset classes. Namely, again, low interest rates are pushing investors into high risk assets, in search of return, also less liquid assets. And as that happens, they are also looking for other alternatives, in particular, for example, gold, that would help them hedge that additional risk, whether it is illiquidity risk or just simply more risk and more volatility in their portfolios. And gold has traditionally been able to help and provide investors with that support. So from that perspective, we continue to hear this growing trend of more and more pension funds, endowments, and foundations looking to have gold not only perhaps as a tactical asset, but even more so as a strategic long-term asset in their portfolios.
How has gold also outperformed major commodity sub-indices over the past 10 to 20 years? And also, according to the same report, what were some of the results that you saw there?
This year, commodities have outpaced gold, in part because, as the economy has recovered, there's been a lot of money bought into the economy, and some of the inputs that commodities create for other manufactured products have increased in price. So year to date, commodities, especially led by oil, have had a very strong performance. However, once you take a slightly longer picture, even if you look at the past 5 years, 10 years, 20 years, gold has consistently outperformed commodities. And again, the interesting perspective here is that our analysis suggests that commodities may be relevant tactical investments at certain periods in the economic cycle, but gold is a far more robust strategic investment, meaning an integral part of portfolios for the long term. And in particular, it is very common in periods of reflation or stagflation for commodities to start to increase in prices first, and then gold to catch up. That has been a very consistent historical trend, in part because when inflation concerns start to reach investors, once they materialize, that's when they start to invest more and more in gold. So consistently, we do see, and this was corroborated in many of the conversations we have with investors, gold is seen as a long-term strategic asset.
And here's a question our audience will certainly be interested in. Why is gold necessary to pair with Bitcoin in investors' portfolios?
Well, it is really important to understand that at present, I think that one particular reason why investors are looking into Bitcoin is because of the really strong momentum trajectory that it has exhibited over the past couple of years. But in addition to that, perhaps increasing price, it has also come with a high level of volatility. And the reality is that at present, the role that cryptocurrencies may play in the financial market is not still well determined until there is a proper framework for analyzing, legal framework, and in particular a regulatory framework for analyzing the asset class. And in this particular case, gold is actually able to help investors manage some of the additional volatility that cryptocurrencies can create. And it is also really important to understand that we're talking about different asset classes. Gold has a dual nature. At the beginning of the conversation, we were talking about how investment demand in particular is responding to either inflation or interest rates and how that influences performance. But we also need to remember that gold has an important component linked to jewelry demand, to technology demand, all electronic components that power computers and other mobile devices include gold in them. And that part of demand is integral to the way that gold behaves. The dual nature makes it a very strong diversifier, a real asset that not only has properties as an investment, but also is tangible and can be used for many different aspects of our daily lives. And not only to complement that, we in addition have central banks adding gold to their reserves as foreign in terms of their foreign reserves, because it's no one's liability and it's an asset that has been tested through time and is a very important component. So throughout all, what we believe is that gold not only is a unique asset class, but it can also help offset some of the additional risks that cryptocurrencies may carry.
All right, and finally, in the last minute here, any additional insight investors should know about gold as an asset class?
The most important thing to remember is that gold, the strategic case for gold can be summarized with 4 key points. Gold can be a source of returns. Long-term, since the 1970s, gold's returns have been in par with the stock market. So it is also a component into portfolios from a return perspective. The second point is that gold is a very effective diversifier. Historically, it has helped offset risks in portfolios, especially in periods of financial turmoil and equity market pullbacks. The third point is that gold is a very liquid asset, and that liquidity can be extremely helpful, especially to offset risks coming from less liquid assets in an environment where interest rates are so low and investors are looking for risk. And then finally, putting all together, gold has historically helped to improve risk-adjusted returns in portfolios.
All right, Juan Carlos, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you so much for having me.